All right, listeners. Now is a great time to talk about a new partner of ours here on Acquired, Legora, the agentic operating system that is redefining how the world's best legal teams work.
Yep, it's sort of obvious that AI is going to completely change the legal industry. I bet most of you listening have dropped a contract into some sort of AI chatbot out there. Legora took that insight and asked the question, what if you really built something with that power from the ground up for the legal industry?
So the founders did exactly what great founders do, operate with obsessive customer focus. They embedded inside a massive law firm for months. They sat with the lawyers just watching how the work really gets done.
And that's how you get features that customers love, like tabular review, where you drop in a folder of hundreds of contracts and it pulls every key term into a grid a lawyer can actually work with. Legora's bet here is interesting. Since it lets each lawyer handle more complexity, any given person can increase the quality of their work and do higher value work. And this means that the pie can grow even as each individual task takes less time.
And they recently launched Legora Agent, offering greater intelligence and performance. The agent lets lawyers set an objective. Then it can handle the planning and the execution and delivery of the final product. Legal teams get to maintain full control and transparency since they're still involved where judgment is required.
And Legora works where you already work. You can use it within Microsoft Word while redlining or drafting. The early Legora numbers essentially speak for themselves. When they have a head-to-head pilot with their top competitor, they win 70% of the time. Legora now has over 100,000 lawyers on the platform from 1,200 legal teams in 50 countries. And crazily, they went from 1 million to 100 million in ARR in about 18 months.
Truly insane numbers. And that is the real test. Plenty of things demo well, but the question is whether a busy associate actually reaches for it during crunch time, or whether a partner trusts it before going into a conversation with a major client. If your legal team wants to check it out, whether you're a law firm or you're in-house at a company, you can learn more at legora.com/acquired and just tell them that Ben and David sent you.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Is it you? Is it you? Is it you? Sit me down, say it straight. Another story on the way. Who got the truth?
Welcome to episode 28 of Acquired, the podcast where we talk about technology acquisitions and IPOs. I'm Ben Gilbert.
I'm David Rosenthal.
And we are your hosts. Today's episode is on the Amazon IPO, and we have an incredibly special guest with us today, Tom Alberg.
So Tom, we know very well because he was one of the co-founders of Madrona, which actually brought Ben and me together. And none of us would be here if it weren't for Tom. But in addition to being a co-founder of Madrona, he has had another very special role over the last 20 plus years, which is board member of Amazon.com. And Tom was the first investor and the first and I guess other than Jeff, longest serving board member of Amazon.
Right.
So we thought it would be fun. We will get through the whole IPO story here, but to read Tom's bio from the S1 that Amazon filed in advance of going public. So Mr. Alberg has been a director of the company, Amazon, since June 1996. Mr. Alberg has been a principal in Madrona Investment Group, LLC, a, quote, private merchant banking firm since January 1996. From April 91 to October 95, he was president and director of Lynn Broadcasting Corporation. And from July 1990 to October 1995, he was executive vice president of McCaw Cellular Communications. Both companies were providers of cellular telephone services and are now part of AT&T Corp. Prior to 1990, Mr. Alberg was a partner at the law firm of Perkins Coie, where he also served as chairman of the firm's executive committee. He is also a director of Active Voice Corporation, Emeritus Corporation, Mosaics Inc., Teledesic Corporation, and Vizio Corporation. Mr. Alberg received his BA from Harvard University and his JD from Columbia Law School. So are any of those other companies still in business except for Amazon?
No, I think, Vizio was acquired for a good price by Microsoft, I think over $1 billion. But you also left out, for example, that I, learned the multiplication tables in third grade and probably was class president in 5th grade. I mean, how can you miss these things?
At Ballard High School, right?
Right,
here in
Ballard High
Seattle.
School eventually, right.
Once again, thanks to Tom for joining us. We're super honored to have him on the show. Let's start with the Amazon story. So I expect most listeners are familiar with the lore of how Amazon came to be, but we'll retell it briefly here leading up to the IPO and ask Tom some fun questions along the way. So Amazon was founded in the summer of 1994, but actually started the idea a little bit before that when Jeff Bezos was a vice president at the hedge fund D.E. Shaw and Company in New York. And David Shaw, the founder of D.E. Shaw, assigned Jeff to think about business opportunities enabled by this new thing called the internet. And Jeff went off and did a bunch of research, and as legend has it, he came across this one report about the growth of the internet that projected that it would grow 2,300% annually for the next, decade or so. And he kind of read that and decided, that's it. I got to be a part of this. I don't want to miss this boat. So he and his wife, Mackenzie, who he also worked with at D.E. Shaw, they quit their jobs and they road tripped across country to the West Coast with no particular destination in mind other than starting a company at the end of it. Jeff writes the business plan for what would become Amazon along the way, and they end up here in Seattle, where they start Amazon on July 5th, 1994, in a garage in Bellevue. Speaking later about this journey, Jeff would come to talk a bunch about what he terms the regret minimization framework. And this is a quote of, there's a great piece in Wired magazine, I think from 1999, interviewing Jeff and ask him about why he decided to leave and start Amazon. And he said, "When I'm 80, am I going to regret leaving Wall Street? No. Will I regret missing a chance to be here at the beginning of the internet? Yes." So even in those early days, Jeff's kind of long-term thinking is evident there. And I'm curious for Tom, is the regret minimization framework something that Jeff talks about in the context of Amazon? What's your experience with that been?
Well, Jeff is he's a big picture, long-term thinker. So I don't think we've really focused so much on that. I mean, I think it was important for him in terms of that decision. But maybe it underlies a lot of his feeling on let's try things. And we can only regret that we didn't try something. We can never regret that we tried something, even if it fails. So it's very much in the mode of failure is okay. Not trying things is not okay.
Awesome. And along those lines of thinking about the origin of the idea for Amazon.com, as I was reading the Everything Store, it says that Jeff and David were on a walk through Central Park when Jeff told him he was going to leave. And
David Shaw, the founder of D.E. Shaw, who Jeff worked for.
Yes. Thank you, David. And it occurred to me.
Not me. Although that would have been awesome.
It occurred to me, the intellectual property and all this original research that had been done for Amazon would have been done at D.E. Shaw. What did that look like? And was that ever sort of a concern that D.E. Shaw would come back later with any sort of claim to the idea for Amazon.com?
Yeah, well, Jeff had signed a non-compete and a non-solicitation agreement. And I don't remember actually worrying about the non-compete, which, in retrospect is kind of interesting. But, and actually, Shaw did start a couple of early internet companies that Jeff was not a part of. And they even had an email company that developed and then went public in the late 90s and merged with somebody. But we did talk about, and Jeff paid strict attention to the non-solicitation of employees, and it was a 2-year limit. And so Jeff, there were people at D.E. Shaw, at least one person who really wanted to desperately come with Jeff and really. Was
Jeff Holden?
No, so Jeff Holden might have been. That might have been Jeff Holden. Jeff was at D.E. Shaw. And I mean, the story is that.
And Jeff is now, I think, SVP of product at Uber.
Yes, I think so. Jeff has had an interesting, Holden has had an interesting career. And we once looked at investing Madrona at a company he had started. The valuation was only about pre-money at $80 million or something.
Wow. Cheap these days.
So we passed on that one. But the But the story is that when the 2 years expired, Jeff Bezos immediately called Jeff Holden and said, "Pack your bags and come to Seattle," which he did, and then several other people from D.E. Shaw followed. But
so in the early days of the company, before it was obvious Amazon was doing well and could recruit all these former coworkers of Jeff's from D.E. Shaw, they spent a whole year actually building the site. So from the summer of 94 till the summer of 95, they build the site, and then they launch Amazon.com almost exactly a year later in July 1995. And along the way, they Amazon raises its first seed investment. And Tom, you were the first, led that first round of angels that invested in Amazon. How did that come together? How did you meet Jeff and end up deciding to do this?
Well, the short part of the story is that Jeff was out raising that first $1 million and began in kind of early 1995. And he was calling on people, and a lawyer friend of mine, older lawyer, called me and said his investment group, he had a little angel investment group, that they had met with Jeff and they didn't really understand this new internet thing. And would I meet with Jeff and give them advice as to whether this was for real?
And your background was in the cellular industry.
Yeah,
right?
I was at that time wrapping up selling Macaw Cellular and Lynn Broadcasting to AT&T. But I did know something about the internet. But this was very beginning. Netscape went public, I think, in like September that fall of '95, and 3 of the key employees at Macaw had been recruited by Netscape: the president, the CFO, and the general counsel. So I was intrigued by it. But anyway. But, you never always say, "No, I don't know anything about it." You say, "Sure." And
that sounds like a very Bezos-like approach to things.
Yeah, well, it's a good thing I said sure. Jeff then called me, and I met with him, and he laid out what he was planning to do. And
the company, the website hadn't launched at this point, right?
No, this was like May of '95, and the website launching in July. And so I was impressed by Jeff. To say that I foresaw what Amazon would going to become would be not true. I don't think anybody, including Jeff, probably didn't fully. I'm sure he did not foresee what it became. I mean, he was excited about the growth of the internet. He had done a lot of research. He had focused on books because it had this ability to have this enormous catalog of books that no single bookstore could afford to carry. And so I reported back to my friend and said, I think it's for real. Well, it's very risky, but, and Jeff is for real. He's obviously a smart guy. He's very passionate about it. And so then my friend who had referred it to me, a couple of weeks later, he called me back and he said, "Well, we called Jeff then after we talked to you, and we told him that the $6 million pre-money valuation was too high and asked him to lower it to $5 million, and he was unwilling to do it."
Oh my God.
So for years,
they passed.
So he passed.
Oh my God.
So years afterwards, and really a wonderful guy. Years afterward, he would give me a hard time.
I bet
about the huge price that you paid.
So the point of it is, it took Jeff almost 12 months. He didn't close until December of '95. This $1 million. Part of it came from his family, and lots of people passed on it, and which is not surprising.
Yeah.
And there were a couple of kind of small venture firms at that time in Seattle. They passed on it. It was too risky in their mind, and it had a lot of risk.
So, Tom, you've seen thousands of startup pitches and met with countless entrepreneurs over the years. Right. Was Jeff like head and shoulders above any other pitch, or was this like super different, or was it like, I meet with a lot of really talented people with great ideas, and some work and some don't?
Yeah. No, I think looking back, it's a little hard, but I don't think he stood out as the only great entrepreneur I ever met. But certainly in the top 20 or 10%. But it was a combination, like a lot of venture. We tend to think the person is very important, but also kind of what they're doing. I mean, it's not always exactly the business plan and the financial model, although that's important. It's often, are they in the right kind of technology and
the right
growth
market.
area?
Yeah.
And because you could come up with lots of reasons why this was not going to succeed. And but the internet was growing. Some commerce was probably going to work.
At 2,300% a year, apparently.
Yeah, right.
It strikes me, one of the things, we talk about this a lot on this show about, the importance of the market and targeting large markets. And it struck me reading Jeff's early writing about Amazon, and in particular, which we'll get to later, the first letter to shareholders after they went public. He really focuses on the market and illustrates how large the market is, even for just books, but then everything Amazon expanded into is. And when you're operating in a large market, a lot can still go wrong, and it can go wrong and you'll still be successful. So that was 1995. And when the website finally launched in the summer, it's funny, we work at Madrona, Tom, many, many startups, and Ben and me several as well. It actually was an overnight success. This is actually, Tom, a quote from you in that same Wired article, quote, by the second or third week, there was $6,000 or $10,000 in sales. And by the end of September, they just launched in July, Amazon was doing $20,000 in revenue a week. And this is Tom, it was clear there was a trend here.
Good understatement.
Yeah, understatement of the century. As that became clear later into 1995 and 1996, lots of VC firms came calling. Amazon and Jeff eventually decided to raise a larger venture round that Kleiner Perkins led in 1996, and John Doerr joined the board. How did that come together?
Well, Jeff had formed a small advisory board of himself and three other Seattle investors, including myself. And
so there wasn't a formal company board at this point, right?
The formal company board was Jeff, but he wasn't ready for a board, but he was ready for an advisory board. So we would talk about, like a board in the sense of, what do we need to do? It's growing very fast. We got to improve the website. We need to do, other things. And so it was becoming clear that it was growing fast, that it was going to take more money than the $1 million, partly just to satisfy growth. And venture capital firms from around the country were calling. And so I came home one night after work at 6 o'clock or something, and my wife said, "Do you know some guy named John Doerr?" And I said, "Well, actually, I do." And I had, in fact, actually,
I've heard of him.
When I was on the Vizio board, one of his partners was on that board, and I guess a couple different ways I had met John. And so she says, "Well, he calls every 15 minutes, and he needs to talk to you now." So
That's amazing.
It illustrates one of John's great strengths, with his persistence. Tells you something about how to sell yourself, show your interest.
A critical trait for any successful venture capital.
We don't always, follow that enough, probably. But and so I talked to John, and he said, "Well, I'm going to meet with Jeff. I really want to be in this deal. I hope you can help me, etc." And so that was sort of partly the introduction. So they were really eager. Another firm that was very eager was General Atlantic, which is an East Coast firm.
Yep.
And kind of one interesting point out of it, I think, is that there was some negotiation on price, and both firms were eager. Both were outstanding firms. And General Atlantic proposed a complicated pricing because we're starting to talk, $80 million pre-money. And that was, although that era started to get hot, it was, reasonably high pre-money for a first venture round. And but they proposed sort of a complicated thing. It would be, $90 million pre-money if it went public, but if it didn't go public within 2 years at a certain valuation, then it was, $50 million. And Kleiner came in with sort of like a straight $60 million at some point. It was a little bit lower than the upside. Yep. And I think we all kind of favored Kleiner Perkins anyway, but picked Kleiner Perkins, partly though on the pricing complication.
So when that round closed, is that when the formal board of directors was established with
right.
you and John and Jeff?
Yeah. Yeah.
Okay.
And a little bit of story there that I think come out before, but Kleiner Perkins, John actually said, "Well, I love you, but I'm so busy. I'm on all these other boards." He was on the Netscape board, I think, at that time.
Right.
And I really don't have time. And so, but here I've got a great partner here that will be on the board. And Jeff sort of said, "Well, I'm sorry, too bad," sort of thing, and talked to us, and we said, well, why don't you just tell him that Kleiner can only invest if John comes on the board? So Jeff, of course, did, and John joined the board.
Wow.
So, yeah, which was, good for Amazon and good for Kleiner and John, obviously.
Yeah. And I'm curious on that. So in the Everything Store, talks about how, and I don't know how much of this is causal, but after that Kleiner invested and John joined the board, that Jeff kind of adopted as a mantra, get big fast. Was that, how did that come together? And in truth, I mean, Amazon did get very big, very fast.
Right.
Was that associated with an investment? What drove that mindset change for Jeff?
I think part of it just came from the fact that we were growing fast. The original business plan back when he was raising the $1 million was he had kind of a moderate growth and a fast growth, but nothing like what he was achieving. And the plan actually said he would break even in year 2. And again, it's sort of fortunately that didn't happen.
He meant to rate year 20.
Right. And so, but it was growing fast. So Jeff also had one of his sort of thesis is sometimes there's in launching a new business, there's a land rush. You want to be first and get into the lead and stay there. And other times, and this is true of launching new projects on Amazon, sometimes he feels there's a land rush and sometimes not. And so you really double down and then the financial markets were clearly willing. I mean, we were in a hot,
robust.
Already the financial markets were bidding up other companies. And so he realized that he could raise a lot of money. And so let's grow fast. And we had the specter of Barnes and Noble sort of saying they're going to get in the internet. So there was a reason then to really step on, the accelerator.
And you and Jeff did. So in 1995, which is the first half year of operations, Amazon did about $500,000 in revenue. And then in 1996, and it was the summer when Kleiner invested, so only half a year with this extra capital to grow, Amazon did just a hair under 16 million in revenue, which is what's that? A 20. That's a large amount of growth. It's so large I can't even calculate it in my brain. And I mean, even today, we don't see companies do that.
No, not in the first year.
And at this point, we were still in the era of Amazon.com was only a bookstore. When Jeff was putting together kind of the pitch deck for that $60 million round and showing it around, was there any inkling that it was going to be more than books at this point? Did he start to foreshadow those other categories?
Jeff, in those early years, was very focused on books. I mean, he declined to even talk about other things for the first 2 or 3 years. And I think that was including through the IPO, as I remember. And partly was, let's do books well. And books is big.
Yep.
But other people were starting to ask and talk about, well, what about other products? And, I suspect Jeff was thinking about that. But it was good, I think, in the beginning. Just let's get this one right. And it was, I can't remember when, but it was probably 98 or so that really launched music and started to launch some other things.
And movies. So at the end of 96, just on 16 million in revenue, Amazon hires Joy Covey as CFO, who plays a central role in the Everything Store. And the company makes the decision, and the board makes the decision that they wanted to prepare for an IPO and go public in 1997, which so at this point, we are 2 years into the life of Amazon as a company, 1 year into it being a publicly available website. You've talked a little bit about the financial markets being open, but how did those discussions? I mean, the board was you and John Doerr and Jeff. Did Jeff come to you and say, "Hey, I think we're ready to go public"?
Well, I think pretty quickly investment bankers were even calling. I mean, it's once something starts to get hot, whether there's substance in these companies or not, there's sort of an investment banker. And that was particularly true in the 95 to 2000 era. People were going public and being worth $30 billion and really didn't have much. It didn't quite happen that way with Amazon because even though there was interest, and I think one of Jeff's motivations, I think the idea that we could raise money at hopefully good valuations and then use that money to grow further was attractive. He also felt that because it was kind of a small, relatively unknown retail company, that it would help the brand to get better known. And, I think that's true on some consumer-oriented companies. It actually can be true even on enterprise startups. We have one, Impinj, that went public this year, and they were not widely known among CEOs. Everybody at the CIO knew them, but once you get public, you start to get picked up more in the Wall Street Journal and the New York Times. It certainly happened to Amazon after it went public.
All right, listeners, now is a great time to tell you about a longtime friend of the show, Vanta. AI has scrambled the whole security picture. It used to be that you proved that you were secure once a year, an audit or a static PDF, then everyone would nod and you're done. But in an AI-first world, that doesn't hold up anymore.
Yep, your risk surface changes every week now. A vendor turns on an AI feature or someone writes in a new model without telling IT, and your posture is different than it was last week, let alone at your last audit. Vanta's own research found that around 70% of companies have this quote-unquote shadow AI running with no security review at all.
Right. And that's where Vanta comes in. They're the leading agentic trust platform, meaning they've built the thing that closes the gap. And the way that they close that gap is Vanta Agent. Think of it as a GRC engineer, that's governance, risk, and compliance, except that it's software and it doesn't sleep. It finds the issues, drafts the fixes, and cuts the time that you'd spend on vendor assessments in half.
In half! Which is exactly why more than 16,000 companies today run on Vanta. Companies like Ramp, Cursor, and Snowflake all stay audit ready and catch the risks that crop up between audits across every vendor, every AI tool, the whole environment.
And that's the real value. Trust has to be continuous now, which is why Vanta automates your security, your compliance, and the work to earn and prove trust. We're huge fans of Vanta over here, and literally hundreds of acquired listeners have become Vanta customers at their companies over the years. So you can get $1,000 off Vanta at vanta.com/acquired. That's VANTA.com/acquired for $1,000 off, and just tell them that Ben and David sent you.
What was the preparation process like? And I'm in particular, I'm curious. The lead left bank on the Amazon IPO was Deutsche Bank, not Goldman Sachs or Morgan Stanley. We covered the Facebook IPO a few episodes ago and talked about the jockeying between the two of those firms for the Facebook IPO. These are the gold-plated Wall Street firms that everybody wants one of them to be their lead book runner for the IPO. But Amazon went with Deutsche Bank, and in particular, the lead banker Frank Quattrone and the lead analyst Bill Gurley, who obviously is now partner at Benchmark. How did that relationship come together?
If you've met and know Quattrone and Gurley, the answer is Quattrone and Gurley. And a broader answer is, I think, Jeff always had the view, and we had the view that big name companies aren't always the best. Goldman and Morgan Stanley have been the top two then and today, and there's a lot of merit in going with them. But it didn't mean that others weren't as good or potentially better. And often it is the people directly working the deal. And so I think they made a good impression, and we thought they could do the job. And
there's a great story told in the Everything Store that after the IPO, they organized a retreat in Hawaii, right? And that
Mexico, I think.
Mexico. That's right. I think it was Cabo, and they had an associate working on the deal who was Jeff Blackburn, and Blackburn came along on this retreat, and I'm sure had interacted with Jeff. There's so many Jeffs at Amazon, with Bezos and the company and the board beforehand. But the net of that was that Blackburn ended up joining Amazon and is still at the company today and member of the senior team there.
Right, one of the top executives.
Yeah. So one of the biggest the biggest things that people who've studied Amazon look at now, and is quite well known, is their ability to spin the flywheel, to add fuel at any given point and increase the momentum of other parts of the businesses in a very almost perpetual motion way. So that superior selection drives a better customer experience, which increases more traffic, which brings more sellers to marketplace, and on and on and on. And
which lowers prices and increases selection, and it's a recursive loop.
It is. Had this early in the company, before the IPO, was this something that was frequently talked about? And was this a thing on investors' minds when they were thinking about investing in the IPO?
So, the actual flywheel concept developed in like 2001 or 2. It rose out of a board meeting and meeting with an outside consultant. But some of the basis of that, I mean, Jeff, from the very beginning, was very focused on customer experience. And, he talked in the meeting with me about we were going to have the world's best customer experience. And it was hard to do in those days because the web wasn't very good. We had, eventually when we launched, it was a black and white website.
Yeah.
There was no publication date on the book. So if you wanted to buy I complained about this. If you wanted to buy a travel book, you didn't know if it was published 20 years ago or 6 months ago. And on a travel book, it's very important. So, but nonetheless, it was like it was genetic, that customer experience. And then, so how do you do that? Well, prices, inventory. And so it was in the background, certainly, and focused, some of those elements. The flywheel metaphor became useful later, I think.
Hearing you talk about that, I've been as longtime listeners of this show know, we are great admirers of Ben Thompson and his aggregation theory. But one of the core tenets of that is that superior customer experiences win in a world where your accessible customer base is infinite and distribution costs are low, which is the internet.
Right.
And really interesting to hear that even in those early days when the internet was so poorly understood by so many people, Jeff got that at his core, that providing the superior customer experience would lead to winning the market.
And not all companies get that. I mean, partly they're focused on short term, partly, how do we squeeze another 2 cents out of the customer? We cut out this product and we save money.
So all of this happens. Quattrone and Gurley win the business, lead the IPO, and on May 15th, 1997, so less than 3 years after the company was founded and less than 2 years after the product launch. I mean, we were talking last week about how Snapchat is to be lauded for going public, having the courage to go public, 4 years after company founding. This was less than 3 years. Amazon prices its IPO at $18 a share, raises $54 million at an initial market cap of $438 million, which is, thinking back today, we'll wrap up at the end of the show with where the market cap is today. But it trades up on the first day, closes at $23.50. But then for the first couple months, it actually trades down. And it's not until the company reports its Q2 revenue numbers later that summer that the shares, when they report that they did $28 million in revenue in Q2 of 1997, which was more than all of, much more than Q1 and more than they did in all of 1996. Right. Then the shares rise again. What was it like in those first couple months after the company went public and the stock traded down? And
yeah, you're right. It didn't have this enormous pop at the beginning. And I think I vividly remember some of this, that it was pretty flat for until those earnings release came out. And even by the end of the second quarter, so late June, I think it was. So the equivalent to today, so if you, there's been 3 or 4 splits which are equivalent for 12 for 1. So if you divide 18 by 12, you get to $1.50.
Yep.
And so it was trading about $1.50 in late June. And then just a couple of other key points, because you can do this, endlessly. But by the end of the year, it was like $5. And then it went to 100 over 3 years or so in those in today's
and,
numbers.
and then the stock split multiple times after that. Yep.
But by 2001, when you had the recession and all the crashes, it was back down to like $6. So there were moments when you could have bought in at good prices, and everybody, it shows partly that the market is not perfect at valuation. But on the other hand, the country was in a recession by 2001, and
Amazon is a retailer,
and it was losing a lot of money, and many people were predicting even then that it was going to die. So, but it's kind of fascinating to go back over those numbers.
Oh yeah, I bet. One of the things we talk about a lot on this show is we try to assess whether an acquisition or an IPO was a good move, and how successful was it. And one of the measures that we use for that with IPOs is what going public enabled that company to do that they would not otherwise have been able to do. So what in the kind of near term, those next few years after the IPO, did they plow that new influx of capital into?
Well, I think Amazon has been rightly known for not making any money and being willing to invest, and to the extent that the financial markets allow you to. And so I think if it had been in the hands of, let's say, an acquiring party, you would not have seen this kind of growth and then innovation and expansion. So, Jeff has had a unique ability to think long term and make it clear he's thinking long term so that the investors understand that this is a long term investment. And he likes to say that you get the investors you ask for, meaning that if you focus on, 2 cents more profit per quarter, then you get investors who focus on that. And if you, it takes you a while, I think, to get the right kind of investors. But if you say long-term cash flow is how we measure the business, pretty soon you get investors who are willing to invest on that basis. And it's possible if you don't grow, they aren't going to like your message and sell, but you end up with fewer short-term investors and more long-term. I think that's helped Amazon a lot.
So I'm super curious on this. We were chatting a little bit before the show, but and this is the perfect place in the story too. So at the end of 1997, Amazon wraps up the year with $148 million in revenue, up from 16 the year before. Incredible growth. But I think, to my mind, the most incredible thing that happens at the end of 1997 is Jeff publishes his first annual letter to shareholders. So the company's been public for 7 or 8 months at this point. And Jeff writes this amazing letter that is included in the annual report, and he's included every year since with his then current year letter as well. And the document is a masterpiece of long-term thinking. How did that document come together? Did Jeff just walk into a board meeting one day and say, "Hey, I think I'm going to write a letter to all of our shareholders"?
Yeah. Well, I wasn't. I didn't help him write it. Unfortunately, I wish I was a co-author. But I think one of the key people in those early days was this Joy Covey, who had been recruited as the CFO. And thinking back a little bit on that, when we started talking about going public, John Doerr said, well, I'm going to vote against going public unless you bring in some more senior management. You can't go public with you and a couple of technical people.
Oh, wow.
And so, it's been a rule that sometimes we violate, but it's a very good, I think, rule that you need, being private is different than going public. Even if you're growing pretty well, you need a really first-class CFO. You need some more marketing power. It's when David Risher was recruited from Microsoft, who was a very important, strong senior executive in those days. We brought in, hired some more, Rick Dalzell, all that. Mm-hmm. He was actually at Walmart, and Jeff started trying to recruit him in January of 97 before the IPO, and didn't get him until after the IPO. And I think Jeff wasn't reluctant on that either, but it was really John in a lot of ways saying you've got to have a stronger, bigger team to go public, and I think it's a good lesson for lots of people. So Joy was, and she also really, Joy was unusual. She was very smart. She'd hadn't graduated from high school. She ended up graduating from Harvard Business School. She came in second in the nation on the national accounting exam. So clearly she was smart, and somehow
an amazing woman. Yeah.
And all she had done in some ways, she'd been CFO of a small company in the East Coast that had gone public.
I believe she was in her early 30s when she joined Amazon.
Very young. But, and Jeff's a very tough interviewer in the sense that, he will interview a whole bunch of people until he finds somebody that he likes and thinks can do the job. He talks about, setting the bar very high. And he had a great lunch with her. He was impressed with her. And she's very smart, nicely aggressive, personable. And so she really drove the IPO in a lot of ways. And I like to say, we set a record for start of the IPO to the finish. But she was also involved in that letter, I think.
Wow.
Speaking of the IPO start to finish, was that hard for the company in an era where it had been doing so much PR and so much marketing, and Jeff had been doing all these public appearances to endure that quiet period?
Yeah, I think, I mean, it was an era when, yes, the company was starting to get a lot of attention. I don't know that the quiet period made a lot of difference. We did get some criticism then and even today on how much we disclose beyond what the securities laws in New York, the NASDAQ requires, that you disclose everything you have to, but there's always this sort of area of, well, what's the cost of a customer? Mm-hmm. How many customers do you have, or how fast is books growing versus video? And Amazon's always felt that that's proprietary. They don't want to let their customers know. They also don't want people focusing on what are in some ways short-term small things, and it'll work out in the long term. And I think maybe bricks and mortar retailers, do they release monthly sales numbers or something? You at least see them.
Same store, month over month growth.
Right. Well, that's an example then of something. And so there's always been a little bit of tension with the analysts wanting more and feeling, well, it's only going to help our competitors. So I think that was going on even then. It was sort of like, well, who are you to not tell us these things?
Well, it's interesting in thinking about company creation from the earliest stages. You get so focused on that cost to acquire a customer number and making that go down and increasing your lifetime customer value. In Amazon's life as a public company, they're so reserved about releasing that information. Have you ever experienced in other private companies someone who felt that was proprietary and that was not something they would divulge in their pitch decks or anything like that?
Yeah, I don't know about that specific piece. I mean, I do think sometimes it also comes up. Another one for some of our companies that have gone public has been backlog. And backlog often, if some companies have backlog and some don't in different ways, but and that wasn't really an issue with Amazon because it was sort of instantaneous sales from any day. But a lot of companies don't want to disclose it because it's misleading sometimes, and maybe it tells things to competitors. Yeah. And so I think a lot of companies refuse to do that, and analysts would love to have it, and it also relates to predicting, a range for next quarter or next year. Some of our companies will give you next year's kind of general expectation, and some won't. I think there's a lot of variation in that.
So one more. We're now post IPO, and we'll wrap up the IPO story in a minute with some fun stats. But one topic that happened a couple years later that I want to ask you about, Tom, is in 1999, so 2 years after the IPO, Amazon did a convertible debt offering and raised $1.25 billion in the debt markets. I'm curious that, and then that ended up being, I believe, the last money into the company through the internet bubble. How getting that large capitalization at that point? How did that help the company survive the crash that came thereafter? And how did it dig itself out of, you mentioned the stock price went back down to $5 at that point.
Yeah. So it was part of the, money was available. We're growing rapidly. Let's take advantage of the fact that, and the interest rates were then
I believe it was
5%.
I think it was 4 3/4, I believe, or right around
4%
there.
or something, which today is sort of where maybe interest rates are. But, given the 20-year history, those were low interest rates. And I think we did 2 or 3 debt deals totaling maybe $2 billion. So on the one hand, it did give us money to grow. Sometimes for companies, having a lot of money lead to bad habits. And just, you acquire maybe some companies you wouldn't have acquired, that are marginal, or you overbuild, and so forth. And so Amazon was increasingly losing money when that recession hit, and I don't think we were any better predicting recessions than anybody else, and or the peak of the market. But it was part of taking advantage of the fact that that money was available. And then when the recession hit, and we were losing a lot of money, and as I remember, some of the terms of some of these debts had no interest for several years,
and then
interest kicked in, and so we were facing, more interest payments. The debt holders, the value of the debt had gone down. There was a lot of pressure from the debt holders. So really, in 2001 or so, the decision, Jeff and the board felt we need to cut costs and expenses, and so. I think we barely did it in time in some ways. We waited quite a while, and because we're hoping, kind of grow out of it, and at some point said, no, we really need to, and there were lots of Wall Street people calling it Amazon.toast and all these famously, if you're going to go out of business. And so we cut costs, and there was this famous saying, cut the crap, which meant, they were shipping bags of dog food was a great example. 20-pound dog of bag food and charging, $3 for shipping and losing a lot of money on it. Well, let's stop selling.
Which is amazing because I now get my dog food for my dog from Amazon. But
well, we cut it out for a while.
I assume Amazon has figured out how to do it profitably now.
But again, it was, so it isn't blind, all speed ahead. It is, when you need to, you cut back.
It's interesting to think about the fact that the pressure from that debt holders forced cost cutting, which was ahead of the rest of companies who had to go to immediate emergency cost cutting mode, and most of them didn't make it. What other factors do you think played into Amazon
Survival,
making it through? Surviving the burst when so many other companies didn't.
Well, it's easy sometimes to look at these and think, boy, they're just following crazy strategies. But I don't think that's true was true even then at Amazon. I mean, they were still focused on customers, and they were getting a lot of orders. And the leverage was a concern or a problem. But underlying economics were not bad. And, so I think that helped a lot, and having good management that stuck it out, and was then was able to focus down on cost controls.
And there are great stories in the Everything Store about those years at Amazon and the impact it had on the culture of it. And I think there was after those years, did Jeff put a moratorium on M&A because they'd acquired so many companies and it wasn't working?
And Amazon's, not famous for overspending on
that's one way to put it.
We've talked about that on this show. We won't ask you about it.
All right, listeners. Now is a great time to thank our longtime friend of the show, ServiceNow. If you are running a large enterprise, AI agents are likely spread across every team, and deploying them is no longer the hard part.
Yeah. The hard part is knowing what permissions they have, what employees are using them for, or what decisions AI is making. AI security for an enterprise at scale is not a small concern. Like, the risks are real.
Exactly. And the challenge with AI is governing it, securing it, measuring it, and making sure that it actually delivers value. That is why ServiceNow built the AI Control Tower.
Yep. AI Control Tower gives enterprises a single place to see, manage, govern, and optimize AI across the entire business. And it works with any AI, not just theirs. Every device on your network, every permission across every system, every AI agent visible and secure in one place.
And ServiceNow can do this because they've spent more than 20 years building the operational backbone of the enterprise, the workflows, governance, approvals, security controls, and institutional knowledge that power how work actually gets done across IT, HR, customer service, finance, and security.
ServiceNow already runs more than 100 billion workflows annually and trillions of transactions for more than 85% of the Fortune 500. So when companies need a place to govern AI at enterprise scale, they're building on a platform at the center of how their business already operates.
And in a future that isn't going to be one AI, it's going to be thousands of AI agents working across every function of the company. But the question is, who's managing them all?
So if you're trying to turn AI ambition into real business outcomes and make it work safely, securely, at scale, go check out servicenow.com/acquired and tell them that Ben and David sent you.
So to wrap up, this has been an incredible story, and having Tom join us for it has been special. So today, we're sitting here in December 2016. As of this morning, Amazon's market capitalization was $363 billion, up not quite 1,000x from the IPO when it was $438 million market cap, but a pretty healthy return. I was in, I was in middle school when Amazon IPO'd. So I really wish I'd put my, bank account into Amazon at that point in time. I was buying Amazon products, but anyway, an incredible journey, and super cool to relive this moment in history. Let's move to talking about what would have happened otherwise. We touched on this a little bit, but had Amazon not gone public at that moment, where would we be? And I guess in particular, I'm curious, was a path of being acquired by somebody in those early days, did it ever come up? Were people seriously interested?
And even if not, like it sounds like it, from our conversation so far, and just knowing the lore of Jeff's mission, that it's very unlikely that he wanted to sell to someone.
Yeah.
Was it ever on the table to raise more private capital or wait it out longer?
Yeah, I think we could have. It would have been slower growth because you couldn't have afforded, if you didn't have access to capital, and particularly when we began to broaden the product mix. When we started, we would get an order for a book, and then we would contact the distributor and have them ship us the book, and then we'd reship it. So we didn't even really have inventory. And so once you start buying product, building warehouses to put it in it, you do need capital. And so obtaining capital in different ways has been, very important for Amazon. And so I think it would have constrained growth. I mean, I know a lot of companies these days, they want to stay private as long as they can. And it does depend on their business model. If you've got a business model that doesn't require a lot of capital, then that's a viable thing. But Amazon's business model, particularly as it grew, did require capital.
Makes sense.
Yeah.
I feel like Amazon exhausted all the options. They're
Yeah.
dead. They want.
We did two kind of events relating to that financing and so forth. One, we had that famous meeting with Barnes & Noble back in pre-IPO, where the Riggio brothers came to Seattle and wanted to do some kind of a joint deal with Amazon, and they weren't actually offering to acquire, but they said, well, you can build our website and your own, and we can both have websites, or we could do it jointly. We could jointly own it. And Jeff, I think, rightly decided he didn't want to do that. And then they filed a lawsuit the day before, or 3 days before the IPO, because we were using the phrase "the world's biggest bookstore."
Yeah.
So, I mean, there are lessons in all that for anybody wanting to go public, that your competitors sometimes do try to take it. But really, neither they nor anyone else really made a run at us, and partly because I think a lot of traditional companies always thought we were overvalued, and so that was actually a benefit. Now, why nobody tried it when we were $5, in 2001? That's when they should have tried. I'm not sure they would have succeeded, but people, everybody becomes pessimistic at the same time. Everybody becomes optimistic at the same time.
Well, it's interesting to, Amazon obviously, it would be a shocker if anybody would buy Amazon today. I seriously doubt that's even possible. But Amazon as an acquirer, it feels like has kind of internalized those lessons. And I think about the Zappos acquisition during the 2008 recession, 2008, 2009, or the Quidsi acquisition, which both of which are written about extensively in the Everything Store. It almost feels like Jeff and the company taking that lesson to heart, that when there are good businesses targeting large markets and for whatever reason are out of favor or in the midst of a recession, that's the time to go shopping.
You don't always have that luxury, but
yeah,
it would be nice if you could.
Should we move on to tech themes?
Let's do it.
Ben, you want to kick it off?
Sure. So in this part of the show is where we analyze, specifically looking at the IPO or acquisition that we're talking about, what tech themes can we extrapolate, either from a true technology perspective or sort of from an investment technology perspective. And there's a few here. I mean, I think the biggest one that we've already touched on is the flywheel. When I think about Amazon, is just like the canonical, colloquial example of how to build the world's best flywheel business, where so many things feed into so many other things and fuel the business. But that wasn't really part of the IPO, as Tom told us earlier. That didn't really get formalized until 2001. So as we think about lessons learned from the IPO, it's a lot about timing company creation correctly around new waves. Yeah. The internet was you have to believe that something is going to be a wave and be a little more contrarian than other people. I think that that's evidenced by the investors that passed in the earliest stages, thinking that it was too risky. But the big thing for me is you have to believe wholeheartedly that you're on the precipice of a wave, and it's not possible to create a top 10 in the world business without being
riding a massive wave. And I think for me the flip side of that coin that I think really shines through in reading about and reading this history of Amazon at that time is the long-term thinking that Jeff and the company and the board had, even in those early days. You have to, if you believe you've identified a wave like that, if it truly will become as big as you think it will, it's going to take a long time, decades. And Jeff is famous, I don't know if this was when he introduced the phrase, but in that shareholder letter in 1997 said, it's day one for the internet and for Amazon. And that perspective is really rare. Lots of people say they have it, but to actually behave that way and make investments accordingly is quite impressive.
It also, applies even today when you talk about new projects or initiatives at Amazon or other companies. And I know Jeff likes to say it often takes 10 years to prove it. And so you've got to after you go public, it's equally important to continue to innovate. Don't stop innovating just because you feel like you're at the top of the mountain. You're not going to survive if you don't keep innovating. And the other is maintain that long-term thinking. An IPO gives you the opportunity to do that because you then have the money to do it. You have to somewhat ignore what the market is doing, though. And that's another important part after you go public, I think.
Yeah, it's interesting you bring up Amazon today as just an observation from the outside. One trend that I think we can observe from Amazon is actually doing corporate innovation well. I've long held this belief that every really great company has one multi-billion-dollar innovation in them, and it's usually their founding insight. And they build that business, and they try desperately to build other ancillary businesses around it. And some are bigger, and some are smaller. Sometimes you get a Microsoft that has an Office and a Windows in them, but usually
Google, right? And not that there aren't great businesses within Google, but it's search.
Yeah, it's 90% on Google display ads. That's or search ads. That's most of the revenue. So the thing that's amazing to observe in Amazon is an incredible DNA for experimentation and small teams and doing things in a lean way. And as we've observed, there's already been one business that's on the scale of Amazon's original retail business with AWS, and
or bigger perhaps.
Yeah, and it'll be fascinating to continue to watch the company and see what else.
I wanted to ask quickly. It's obviously this happened much later than the IPO story, but about AWS, the listeners to our show might also listen to Ben Thompson and James Allworth's podcast Exponent, and on one of their recent shows, they were talking about platform mentality and the importance of that at Amazon, and perhaps how much DNA came from Microsoft into Amazon in terms of thinking about AWS as a true platform. And Ben and the show, they posit that this great Bill Gates quote that a platform is when other participants on top of you realize the vast majority of the economics in the industry, and you only collect a certain, a small percentage. It's not like a high margin, Google like business. How much, thinking on that level happened at Amazon and during that creation?
Well, I don't think we thought we were, kind of following a Microsoft model. Although I think from the beginning, everybody in Amazon recognized that Microsoft had the potential on the cloud to be the most important competitor in that as they have become. But the difference in a way was platforms were somewhat considered static in the sense that you built a platform and then every couple of years you revised it or you sent out new software or machines. And the internet was so much constant iteration. And so I think that, I've never heard this from Jeff or others, but it seems to me with AWS, the difference in a lot of ways, why it's succeeded and been able to take this lead and keep it, partly was being first when others held back, but the constant iteration of AWS. It's like revising your internet site. They had 600 new features this year or something. Well, in the old days, platforms didn't do that. You came out with Windows 8 or 10, but it was 2 or 3 years of massive coding. So I think the world even on that has changed a lot.
Right. Yeah, that's a great point. One other question before we move out of trends and themes is, as you're looking at companies that are pitching Madrona for investment in recent history, what are things that you learned from Amazon being so successful that you sort of look for in other companies as a pattern matching based on Amazon?
Well, every company isn't going to go public and every company isn't in it probably for the long term, but I really do prefer founders who have a long-term vision and at least in the beginning, say they're going to stick with it. And I think, again, it's almost genetic, though, and you don't know it until it happens. And there are lots of reasons to sell your company, and your market didn't turn out quite what you thought, but you're going to get a good price. But what I really, hope is that a founder, if he's riding the wave, as you say, or has other reasons, doesn't sell out when he could be in it for the long term. And again, it's somewhat personality. And I think, I was very fortunate that Jeff was in this for long term. And so even at moments when he could have gone out and sold the company, he wasn't interested. He wanted to build something for the long term. And, when you think about a lot of the great companies, they've had founders who really wanted to accomplish something kind of beyond making the profit. We're going to change how people think about software. We're going to change how people do search. So I think, that doesn't guarantee a successful company, but I always like that longer term, they're thinking about it and hopefully going to seek it.
Cool. Thanks.
Should we wrap up?
Yeah. You want to grade it?
Yeah. This is, in some ways this is tough. I'm thinking of the coda to the Everything Store, which is, Joy Covey, and, the letter that she wrote to Brad, an email that she wrote to Brad Stone, and she was one of the key sources for the book. After having done all the interviews and just reflecting back on her time at Amazon and then the experience of talking about the story, and she said, Jeff and the company kind of like he knew in the very beginning exactly where he was going. And, so many, as we talk about on the show, so many startup stories and IPO stories and M&A stories are twists and turns and wild rides. And it feels inevitable that the company would have went public when it did, especially, just hearing the story now. It was completely rational. It made sense. It gave the company the scale and the capital and the visibility that it needed to grow and outpace competitors. So in some ways, I guess I think I give it an A. I do give it an A, but this might be like the least controversial or thought-provoking decision we've had so far on this show for me.
Yeah, it's funny. I was just thinking that the same thing. There's actually not a lot of analysis that needs to go into it. I mean, you look at the scale of Amazon today, and even the scale in the years shortly after the IPO. The only way that they could have achieved the outcome that they did was by going public. And I think that one reason why we had so much trouble in that earlier section of what would have happened otherwise is it just doesn't seem like there was a lot of choice.
It feels like unnatural to think about an alternative history here.
Right. And as someone who works on early stage startups, a lot of the time there's all these like really vague questions around, okay, we think we have an idea in the space and we're learning as we're going, and, should we be a platform provider, or should we be the, business that sits on top of it, or should it all be combined, or should we be a horizontal or a vertical business in this space? And you even go back and forth long after you started the business, kind of playing both sides there. And it just doesn't seem like Amazon had any ambiguity over what the long-term vision of the company was, at least the retail business.
So Tom, hearing that, do you agree, or are you laughing at us saying like, oh, easy to say from this vantage point?
Well, on the one hand, I don't think any of us really did understand what Amazon would become, but I think the fact that Jeff and several of us thought the internet was going to be a very big deal, and there was lots of potential, and who knew where this could take you. And I think that often happens with technology, where you realize that something is going to be very big, but knowing the details, that today AWS would have come out of that. There was no way to predict that or think about that in those days. But again, that fits very well when you look back and say what the assets of Amazon were, but also what the technology development. So I think Joy is right in the sense that it was in some ways inevitable. I'm just not sure we knew how inevitable it was. But it took, fabulous commitment to innovation and really, hiring good people. So you should not neglect that for inevitability.
Right.
Yeah. Okay. With that, carve outs. And it will be interesting to think how many of our carve outs will be available on or some way served to you by Amazon.
I'm sure Amazon's in delivery there somewhere. Either
no matter what your carve out is, Amazon is involved in it.
That would be interesting to look back at our previous carve outs and figure out, are there any that are not served to you either on AWS or be able to be shipped to you, or we'd have to pick something that's basically not a physical good, a physical good that's on some very, very stubborn retailer that retails only on their own site. So I don't know. I mean,
site that is not hosted on AWS.
Yeah.
Or uses technologies as part of the site that are not hosted by AWS. It would practically be impossible. So
yeah. I guess that's why Amazon deserves that A that we mentioned a few minutes ago. So my carve out is a band called the Album Leaf. I actually went to their show last night here in Seattle. I've been a longtime fan of the band. They're some of the best working music that you can imagine. It's a lot of percussion. It's a lot of very like mellow synth, but it's got a little bit of a punch to it. So it's kind of hard to describe, but check out the Album Leaf. They're on Spotify. I'm sure they're on Amazon, and great band.
Cool. That's I'll do a quick side carve out then. It made me think. Jenny and I went to the Stevie Nicks show this weekend in Seattle, and she was awesome. Her 24 Karat Gold tour, so great songs. Some of her hits, some of Fleetwood Mac's hits, but mostly, and what I enjoyed the most was just songs, from the vault, as she called them, that people don't know. Super great. My official carve out though is there's a great article that we'll link to in the show notes. Very fun. there's a seminal paper in Harvard Business Review from the mid-90s, right around when Amazon was being started, by Brian Arthur, and it's called Increasing Returns and the New World of Business. And it's somewhat academic in topic, but the thesis is that in an internet world where distribution costs are very low and your accessible market is everyone, you can actually, this old economic theory of diminishing returns that the bigger you got, the classic example is coffee plantations. The more coffee you produce, you're going to go to worse and worse, less and less fertile ground, and your coffee is going to get worse and worse, and so you get diminishing returns. On the internet, you actually get increasing returns. That the bigger you are, the bigger you get, and the better your customer experience becomes. That contributed sort of the spiritual antecedent to aggregation theory and Amazon and many of the things that have happened. Super fun thing that came out is turns out that Cormac McCarthy, the author, the novelist who wrote all the Pretty Horses and No Country for Old Men and many other Pulitzer Prize winning author, Brian Arthur, the economist who wrote the article, he went to Cormac McCarthy for help writing this piece. And so Cormac basically dismantled the whole piece. They reassembled it together. And when you read it, it reads extremely cogently, not like a typical economic, academic paper. And this story came out recently. Very fun.
Oh, well, I should appropriately say that on my Amazon Christmas gift list that actually I've given to my wife is the Undoing Project, a book by Michael Lewis. And I think a lot of us, I like to read books on new technologies. Machine learning is, popular subject around Madrona, and we've been reading books on things like that. But here's one that's not particularly focused on numbers or technologies, but a different kind of technology, which is the psychology of people, which, again, is super important in business. So I think I look forward to reading it.
Yeah, I haven't read it yet either, but I can't wait. Danny Kahneman, the book's about Danny Kahneman and Amos Tversky, Nobel Prize winners for basically developing behavioral economics. And Daniel Kahneman was and is now an emeritus professor at Princeton, and Michael Lewis is an esteemed Princeton alum as well. And I took Kahneman's course when I was in school there, and sadly, it was the first year that he had retired and he didn't teach it. So somebody else did, but I took his course and had a huge impact on me, and looking forward to reading the book.
All right, listeners, now is a great time to talk about one of our favorite companies, Statsig.
Yes, long-time acquired partner. There is a reason why the best product teams at companies like OpenAI and Notion, Atlassian, Figma, Rippling, Brex, and more rely on Statsig, whether they are iterating on their core product features or shipping AI-powered experiences at scale.
Yep. In the crazy speed of today's AI world, shipping fast is just table stakes now. It's basically trivial to build and deploy your app constantly. The real advantage is how quickly you learn what changes actually created value for customers and how fast you can use that signal to guide what you ship next. Whether it's a feature tweak, a pricing change, a performance improvement, or an AI update like a model change or prompt adjustment, they're not relying on instinct. They're measuring what actually moved engagement, retention, and ultimately revenue. And as more teams build with AI, that learning loop becomes even more important. Building with LLMs introduces non-determinism into your product experience. The same input doesn't always produce the same output, and behavior can shift in subtle ways in real-world use.
So doing offline evals will give you part of the picture, but you can really only understand the impact once your product is live with real users, and then you can measure how their behavior actually changes. It's very different than the way that you would ship features in a pre-AI world where you knew exactly what the software was going to do in production.
Yeah, exactly.
So this is where Statsig comes in. It brings experimentation, feature flags, and product analytics into one unified system so teams can ship safely, test rigorously, and directly link what they changed to how users actually behaved. The result is a tighter feedback loop and learning that compounds over time, so you don't just ship more, you ship better.
So if you want to make learning your competitive advantage, whether you're building new AI experiences or just evolving your existing core product, go to statsig.com/acquired to get started.
Great. Well, that's all we've got. If you aren't subscribed and want to hear more, you can subscribe from your favorite podcast client. And if you feel so inclined and you're a longtime listener of the show, or if you're new and just joining us for this episode, we would love a review on iTunes, or if you share it on social media with your friends. So thanks so much for listening, and have a great day.
Thank you to Tom for joining us.
Thank you. That was fun.
Who got the truth? Is it you? Is it you? Is it you? Who got the truth now? Huh?